technical session on business development and latest judicial trends. I request the speaker of the session, CA Manish Dafria, to come on the dais. I request CA Ramchandra Reddy to welcome our speaker with the flower bouquet. Thank you, Ramchandra. Dear members, business deductions have always been backbone between the computational and department and the SEC. With the several number of disputes unresolved at the time of scrutiny level, department and the SEC have faced the problems. With the guidance to resolve their issues, we are the professional to be able to update with the latest judicial issues and cases. I have great pleasure to introduce our session speaker, CA Manish Dafria. This is the profile, it's very great interesting profile. Professional balance sheet of CA Manish Dafria. In the balance sheet, both sides, in the asset side, this consists of BCom in 1989, MCom 1991 from Indore, CA 93, MA Economics 1995 from Indore, and DISA ICA 2002. If you go for segmental wise reporting to Manish balance sheet, two segments. One is the professional segment, that is managing partner from VK Dafria and Coach Accountant Indore and academic, another segment. He is also visiting faculty from IIM, that is the premier management institute of our country. He is also visiting faculty from State Bank of India and delivers lectures on taxation, financial matters related to banking industry. And if you go for liability side, and one is the special reserve in the Manish balance sheet, nominated by CBDT member of Regional Director Advisory Committee, Indore, for 2 years, 2011 and 13. And he was the managing committee member, Indore branch, held the post of treasurer and vice chairman, and represented Indore University in the state level youth festival in quiz and debate of competition. He held post of joint secretary, and vice president in the student union of Gujarat Commerce College, Indore. And also, I find that one more interesting point that is missing in the balance sheet is cash and bank balance, not mentioned. I request the speaker to enlighten on that. This brief introduction, I request the speaker to take the technical session.
Respected Central Council member, CHA Venkataraman and the Devlaja Reddy in absentia, managing committee members at the branch, seniors in profession, friends. See, the balance sheet which has been drafted by me as my professional balance sheet, the cash and bank balances are missing. But say, as a chartered accountant, I don't want to disclose the cash to say public at large. So that is the basic reason. Wherever I go, I keep on collecting lot many say good wishes and say friends like you people. So that is really the say bank balance which I keep on accumulating. Nobody can tax that particular balance. That is my way of looking at things. Thank you very much, Hyderabad branch, for giving me this opportunity, coming all the way from Indore to this Hyderabad. And one person who is responsible for bringing me here is our learned Central Council member, Mr. J. Venkateshwaralu. For whole of the year, he was pursuing me, Manish, you have to come to Hyderabad sometime, and probably this time the situations become favorable, and that's how I am here. The topic which has been assigned to me is business elections, the recent judicial trends. I know my time has already been cut short. It's not very long when the room will fill up with the aroma of great basmati rice from Andhra Pradesh that the lunch is being served just outside. So probably I will very soon get a slip from organizers, please wind up. So without wasting any further time, let's straight away come to the topic. So I always feel this business direction is the most challenging area of income tax. Though my previous speaker will immediately point out that EDS is fast catching up, but still the business direction, for one very simple reason. In 8 out of 10 assessments which we face before income tax department, the business direction is always an issue. And our learned assessing officer will always find one way or another to make some deductions, some disallowances somewhere in the assessment. It's a pet topic of the income tax department, and that's why it becomes necessary to keep on discussing this recent change in business direction again and again and again. I've selected some 8-10 different topics ranging from different areas of business directions. Earlier speaker was saying EDS is a small part, only 46 sections. Business directions is even smaller part, from section 30 to 36 are available. And then of course we have section 40A, IA, 48, 2, 48, 3, 43B something, which are talking about when the deductions will not be available. So even in this smaller part of income tax, if we can have so many controversies, so many issues, so obviously TDS is bound to have its good share of controversies. The case law which I have selected, let's start first with a very recent decision from the Supreme Court. Depreciation. The whole problem in the business income starts with this depreciation. Section 32 comes in the very beginning of chapter, and it has its own share of lot many issues and controversies. So let's start discussing with this first part, whether depreciation is available on goodwill or not. So we know that Income Tax Act provides depreciation for intangible assets. Now how it defines intangible assets? It says intangible assets being know-how, patents, copyrights, trademarks, license, franchisee, or any other business or commercial right of a similar nature. We all can see goodwill is what they call in English is conspicuous by its absence in that particular definition. So I always feel our tax laws have a very strange way of dealing with things. Then they have to say no to any particular thing. Normally, they do not say no directly. By not saying yes, they try to say no. This is how they handle the situation. So, same is happening in this particular definition. The goodwill has not been mentioned. And that's why, whenever assessee wants to claim a depreciation on goodwill, the dutiful assessing officer will always say, no sir, this is not possible. The goodwill is not mentioned there. Now, what happened? The matter, one particular case went up to the Supreme Court. This is Smith Security Limited. There was a scheme of amalgamation. Company paid some extra amount for this, excess amount over the assets and liabilities which they have taken, and they tried to claim this excess amount by way of goodwill. Assessing officer simply says that not possible. Section 32 clause 1 explanation 3b nowhere talks about the goodwill, and that's why depreciation shall not be available. Summarily rejected by AO. Matter traveled up to Supreme Court. Supreme Court read the section very carefully, and more particularly they read the words any other business or commercial right of the similar nature. This led the Supreme Court to apply the age-old principle of interpretation, the principle of eius in generis, That is a principle of similar things. When law refers to number of specific things and when it refers to a general thing, that general thing should also cover whatever has been referred earlier. And based on this logic, then Supreme Court has said that goodwill is also eligible for section 32 subsection depreciation. So whatever amount has been paid by way of goodwill, the depreciation can be claimed. 252 CTR 233 Supreme Court decision, Smith Securities. I always wonder why in the first place the lawmaker can never think about what may be the possible consequences of whatever provision they are making. As a professional, we do not have an issue. If you want to give a depreciation on goodwill, give it. If you don't want to give it, don't give it. But please be clear whatever you are providing in the law. If you want to say no depreciation will be available in goodwill, write it very, very clearly that goodwill will not be included. Why do you create a room for all these kind of controversies and disputes and matter traveling to the Supreme Court? So this basically is the problem related with the drafting of law. If they do not want to include goodwill, they should have said in so many terms. But then Supreme Court is now saying, because the word used as any other business or commercial right of the similar nature, the goodwill is now also eligible for depreciation. In one more similar case, which I have mentioned in my paper, one assessee, basically a shareholder, has purchased client list from some other company and tried to claim some 2.5 crore payment has been made for that client list. And this assessee now tried to claim depreciation on that 2.5 crore client list which he has paid. Again, our assessing officer simply denied, not possible, explanation 3B nowhere talks about this kind of payment. But then again, Bombay High Court has said that no, client list is also a type of goodwill eligible for depreciation. So now the controversy, well settled, Supreme Court is saying that the goodwill is eligible for depreciation. Coming to second topic, and this is earlier we were discussing about this TDS. So this again talking about TDS with the angle of this section 40A IA. Okay, we used to call it 40A 1A, but I normally call it 40A IA. In Hindi, IA, that means IA. Come in, please. So assessing officer is trying to invite you, and then he will say make all the kind of disallowances. So this 40A IA. Assessing officer, you will always find they are some very over-genius kind of person trying to stretch the net of income tax act as wide as possible. In this particular case, what has happened, assessee has made some payments which he has actually capitalized. The payment has been made to a foreign company for acquiring some trade name or something. Trade name is already eligible for depreciation. Now, because this was a payment to a foreign company, 195 TDS was applicable. Assessee failed to make that particular TDS. Assessing officer pointed out, okay, no TDS has been made, so all the consequences of TDS, that is this interest and life penalty and everything. And at the same time, he said that this is a 40A IA violation also, and I will disallow this payment under 40A IA. Which payment you will disallow? This is a capital expenditure, so I am not claiming this as a deduction. He says, no, you are claiming depreciation, so I will disallow that depreciation also. To what extent the imagination can fly? This is something really mind-boggling sometimes. And they say, no, there is a violation of law, so you need to pay the consequences, and I will disallow the depreciation on that capital payment which you have made. Decision. Tribunal ultimately had to come to the rescue of assessee, asked assessing officer, please read the law very, very carefully. 40A IA simply talks about any expenditure which has been claimed as a deduction, that can be disallowed. Whatever has not been claimed as a deduction by the assessee, you cannot disallow that particular thing. I am not claiming that as a deduction, how you can disallow it? I was just pondering over the point which has been raised in earlier session, that 118 rupees 2 times reduction. Now again the same point, assessing officer can always go for this kind of disallowance. I am claiming claiming it as deduction for one time and you are disallowing it for 2 times. The great assessing officers can do whatever they think. So similar is the situation, and then tribunal has said that assessee has not claimed any deduction, he is only claiming a depreciation. Depreciation is absolutely on a different kind of footing. You are capitalizing some expenditure, no TDS has been made, penalized for interest, levy that penalty, whatever you want to do, but for God's sake, no section 48 IA is applicable in that case. Mumbai Tribunal, SKL Berries Limited, 142 LTD 49. Now this principle can be applied in a number of cases. Say for example, I am constructing a building. For construction of that building, whatever say payments I am making to that particular contractor, somehow I missed that particular TDS, I will be liable for interest, I will be liable for penalty, but obviously that would hit my cost of construction. My actual cost of that building cannot be changed, depreciation cannot be denied on that particular ground. Helps. And this is something very interesting. Deductibility of various kind of penalties, whether they are allowed under the Income Tax Act or not. As per our say learned friend, any penalties are never deductible. Why? Oh, we have that explanation in section 37 subsection 1 which says that any expenditure which is an illegal kind of expenditure and that will not be allowed. And on that particular ground, assessing officer always take this particular view, any kind of penalty you are paying and that will be simply disallowed. The point is, what exactly is that explanation to section 37(1) is saying? That explanation is basically saying that any expenditure which is an offence that will be disallowed under section 37(1). The expenditure itself should be an offence, then only that disallowance will come into picture. When the section has been introduced, CPDT has came out with a clarification and they have given some example, what kind of payments will be hit by that particular explanation, and they have said payment like drive and all those things. They are making the payment of drive itself is an offence and then the expenditure will get disallowed. Now a penalty which is being paid, that might be for an offence committed by an assessee, but the paying penalty by itself is not an offence, by itself is not prohibited by law. On the contrary, the law itself is imposing that particular penalty. So in any case, any penalty which has been paid by the assessee, in my humble opinion, that is never hit by that explanation to section 37(1). The only point of disallowance of a penalty can be the test of commercial expediency, the age-old test of allowing the business expenditure. Whether you can say that the penalty has been incurred wholly and exclusively for the purpose of business or not. I am reminded by a 1962 case of Supreme Court, I am not really sure about the citation, Haji Abdul and Shakur brothers, something like this, where Supreme Court, at that time Supreme Court has said that any penalty for violation of law cannot be disallowed simply because it is not for the wholly and exclusively for the purpose of business. There is no issue about say illegal kind of situation coming into that particular penalty. But income tax officer, as they are, they will always say, they will always relate this penalty with this 37(1) proviso, and they will say since this is illegal, that's why this allowance will not be there. Now, number of cases have been reported very recently where courts have made a distinction. That is a penalty for the infraction of law and a penalty paid in terms of a contract, any penalty paid for breach of a contract. These two are entirely different kind of situations. Infraction of law penalty, that is not allowed because this is not wholly and exclusively for the purpose of business. This fails the test of commercial expediency and that's why this legal penalties are not allowed. But any penalty which has been paid in the ordinary course of business for the purpose of running of that business, that is never hit by whatever explanation that 37(1) is giving. First of case, assessee here was a share broker, paid some penalties to the stock exchange, and the business of share broker, they need to, they keep on paying number of penalties for say late delivery of shares or for say exceeding their say exposure limit or something like this. All these penalties have been paid to stock exchange. During the course of assessment, assessing officer simply see the word penalty. Oh, there is a penalty, let's disallow it. Okay, this is how normally they operate, and then I always feel this is bound to happen when all the assessments are to be completed within that short span of say 1 or 2 months time. How this whole say assessment procedure say develops in our say income tax department is something very interesting. Okay. Till 30th of September, they will be say issuing those notices. Then say notices will be coming and then we will be filing, okay sir, give me a questionnaire kind of thing. Then assessing officer will say, okay, come in somewhere in the month of next March or April or something like this. Then as a consultant, I will say, sir, now I am busy in filing of returns and tax audits and something like this. Next September will come. After September, Diwali will come. Then December, they will start thinking, oh, I need to make some kind of assessments also. Generally, then they will start issuing the questionnaire. By March, the assessment is to be completed. So everything needs to be completed within that short span of say 50-60 days maximum. So what they will do, they will simply see a particular word, okay, this is a penalty, without going into the details, and that will be simply disallowed. So then they disallowed, okay, this is a penalty which you have paid, 37(1) explanation, I will disallow it. Okay. Then appellate authorities again came to the rescue of assessee. Tribunal has said, Delhi Tribunal basically referred to their earlier decision in the case of this Master Capital Services 23 SOT 60, and they said that this penalty is not for the violation of any law. You have exceeded the exposure limit, there is some say late deliveries given by the client. It is a normal business of any shareholder business, normal part of any shareholder business, and that's why this is exclusively held, fully and exclusively held for the business of assessee, should be allowed as a deduction. Another recent case, it's a very recent kind of decision. Assessee was having a membership of this Apparel Export Promotion Council, got some kind of export quota, export entitlement. Now what happens in this case, you needed to furnish a bank guarantee to that council that you will actually utilize that particular quota. The export quota is very limited, so we are giving you this particular quota in place of somebody else. So you needed to say fulfill your commitments. For this, they take a bank guarantee. Assessee started making exports, then he realized that exports are not viable, the prices are not suitable in the international market. If I will continue to export, there will be a loss, and assessee decided to get that bank guarantee forfeited. Rather than incurring the losses in export, he decided let the bank guarantee be forfeited by the council. Council forfeited that guarantee, assessee claimed the deduction during the assessment. Again, assessing officer see this is a kind of penalty, I will not allow this as a deduction. Tribunal saved the assessee, matter went to Bombay High Court, and Bombay High Court has again confirmed the decision of tribunal and simply mentioned that this is again not a penalty for infraction of law. This is a normal routine business activity of the assessee, fully and exclusively for the purpose of business. The deduction should be fully allowed. Legally Actuarials Private Limited, very recent decision, 32taxman.com to 37 Bombay High Court. The point which these decisions are trying to make, the trend towards which these decisions are indicating that penalty for the sake, by the name of it, for the sake of it, you cannot disallow the penalty. 37(1) explanation never talks about disallowance of penalty. It only talks about any payment which is against the law. Where making the payment itself is an offense, that only can be taken into that particular explanation. Otherwise, any penalty which has been paid in the normal course of business, that is allowed.
Read this along with 14A, it will make any difference.
14A.
Yeah, because here you are forfeiting your bank guarantee.
Okay.
That means you don't generate your business income.
Mm-hmm.
So then this qualifies for disallowance.
No, but 14A I feel is on a very different footing, sir. 14A talks about say income which you have earned and that is an exempted income. Then 14A disallowance will come. Here I am talking about cutting down my losses. If I will continue doing that particular activity, I will incur more losses. So I took a business decision. Rather than incurring losses in export business, I prefer to say lose the bank guarantee money. So in my opinion, there is, the relationship with 14A is not there. My submission. Okay. Now, coming to say the next part of this discussion, Earlier 2-3 cases, the say depreciation on goodwill and then say assessing officer trying to disallow this penalty, we have seen that these were the cases where assessing officer actually tried to push the limits and then courts have actually saved the assessee. Now here is a case where assessee is testing the limits of the law. To what extent I can say get the benefit. Fortunately, court is say coming to the rescue of assessee, court is say getting success at the court level. The point is this: assessee's ex-director's son, who was an employee of the company also, he went for some kind of foreign education. Assessee was engaged in the business of printing, distribution of newspapers, magazines, etc. This employee of the company, he went to London for advanced study in printing technologies. Assessee claimed that as a deduction. The assessee, so the person who is went for that education, he was say son of the ex-director of the company as well as employee of the company also. Assessing officer said that not allowed as a deduction, personal expenditure, not fully and exclusively for business, and simply disallowed. Tribunal analyzed the matter in a very interesting manner, and sometimes it happens. So say decision depends how you see the situation. What is your say order of seeing the situation? Tribunal has said how you see it. You see it first as a son of ex-director, then as an employee of the company. Then probably you will come to conclusion that this is not allowed. If you see first as an employee of the company and then see that this employee also happens to be son of ex-director of the company, then your perspective changes entirely and then probably the deduction is allowed. So then the tribunal started seeing the whole situation from this particular angle, that this is your employee, might be son of ex-director, but this is employee, went for a study which is related with the business of the company, came back, continued with the say service with the company, and that's why the expenditure is related with the business of the assessee should be allowed as deduction. Department went to High Court. This decision from MP High Court, my own city from Indore, my Union News and Networking Private Limited. High Court observed that whatever tribunal has regarded, that is a factual finding. It's a question of basically facts. The employee was employee of the assessee, went for the studies, they were related with the business of the assessee, came back, continued with the say service of the company itself, and that's why the expenditure should be allowed as a deduction. High Court has said merely because that employee was son of ex-director of the company, that cannot be a ground to disallow that particular expenditure. Interesting decision. We can have our own views of the things, but number of times this happens. As again in the say earlier session it has been said, there are two types of clients. One client who will always come to us in advance, and second client who will always come at the end, 1 year, 2 years after this has happened. So there are decisions which will be helpful for first type of client, and then there are certain decisions which will be helpful for second type of client. Okay, now you have done it already. Let's try to find out whether we can save you from somewhere or another. So some kind of decisions are there of this nature. But again, what happens? Any thought process based on decision, any say tax planning or whatever we call it, if it is based on decision, it needs to be seen very, very carefully, because every case law is a very different story. A slight change in the facts and you may have a completely different kind of decision, a completely different kind of situation. So before applying any particular decision, we need to find out whether the facts are exact fit in the case of our client or not. Say for example, the similar kind of situation where somebody is going for a foreign study, MP High Court is allowing that particular deduction. A similar case with a slight change of facts. Here the person was the director of the company itself, gone for say study in UK. Company claimed that expenditure as business deduction. The claim has been disallowed, matter travelled up. High Court here disallowed that particular expenditure on the simple ground that no bond has been executed by that particular person, whether he will continue with the employment with the company or not. So more or less similar kind of situation. Some person is going outside for their studies. In one case, High Court is allowing. In second case, they are not allowing. By taking this particular aspect, that no bond has been furnished, that this person shall continue with the studies of the say service of the company or not, and on that ground, now this say Delhi High Court is disallowing that particular decision. Both of them are say more or less came at the same time. Natco Exports Private Limited, this is this Delhi High Court decision, and they observed that after completing studies in UK, the employee, that particular student, has applied for further studies in USA, and that's why we will not treat this as a business expenditure. In Nagunia's case, the person has came back to India for continuing with the service, and then they are saying yes, this is allowed as a deduction. In second case, slight change of tax, and you have entirely different kind of decision. So this happens. This is always a risk which will carry whenever we are trying to rely based on any decision of court, whether the case is exact fit into my situation or not, then only that particular proposition may be taken. Coming to another, say, very interesting kind of, say, trend which has developed over, say, recent period of time, since last 2-3 years. This is one particular area where courts have started taking a very different kind of view as compared to what was the situation earlier. This is a case of assessee, say, having a liability, a foreign exchange liability. As of 31st March, assessee is doing a mark-to-market kind of calculation, revaluing that liability based on forex rate as on 31st March. In the process, some notional loss is being created. The point is whether that notional loss is allowed as a deduction or not. The liability is a, say, foreign exchange liability. I have took a loan, I have purchased some raw material on credit basis. When I have purchased, the rate of dollar was something around 52 rupees. As of 31st March, now dollar is, say, 55 rupees. So this 3 rupees extra, which has got created on 31st March, it is a notional loss. Whether I can claim this as a deduction or not. Notional loss. The conventional thinking will be that since there is no actual say loss which has occurred, it's only a mark-to-market kind of valuation, this might be necessary from the accounting treatment purposes. But as we all know, income tax and accounting are not very good friends. Okay, the say stand of income tax department is always like this, that whatever you want to do, you keep on doing in your accounting. In income tax, we will do as per our own way of thinking. So this is a notional loss, and assessing officer has dutifully rejected that this loss cannot be claimed as deduction. Okay. Now, what has happened further? This is a trend which has been actually started in 2006 by a Delhi High Court decision. Then this decision has been confirmed in 2009 by Supreme Court, and then lot many further tribunals and high courts have elaborated that particular decision. In this case, assessing officer rejected at appellate level, at tribunal level, assessee succeeded. Finally, matters say traveled to High Court. Karnataka High Court decision 312 ITR 254. High Court simply referred to the Supreme Court decision in the case of Woodward Governor India Private Limited. And I sometimes feel that some decisions of Supreme Court are having, say, the weight more than probably whatever is written in the income tax. Some decisions are always there, like say we talk about, say, Bokaro Skills Limited or Tuticorin Alkali Center, and not many Supreme Court decisions. Probably this Woodward Governor India Private Limited also goes into the, say, same line, absolute landmark kind of decision, creating an altogether new law. Where the Supreme Court has said that this foreign exchange notional loss that can be claimed as a deduction by the assessee. The only question is this: what assessee has done in the earlier years? What was the accounting treatment he has given to the similar situation in the earlier years? Say there is a possibility in earlier year there was a profit because of this revaluation of foreign exchange liability, whether SAC has offered that profit for taxation purposes, and in the case which was before the Supreme Court, Woodward Governor India Private Limited, that was the case. When there was a profit, SAC has offered that particular profit. So there Supreme Court has asked to the department that when there was a profit, you were not having any problem. That time you have not said, no, this is a notional profit that should not be taxed. So now today there is a loss. Why you are having a problem? When profit has been accepted, the loss is also required to be accepted. So SAC is following that accounting practice consistently. Now it's a settled law of land that whatever is the notional loss because of revaluation of a foreign exchange reserves, a foreign exchange liability, all these losses are allowed as deduction. But then, before we say conclude this particular principle, there is one very important point we need to consider. What is covered by this Supreme Court decision and all the decisions which have followed is the forex fluctuation loss when the say forex liability was on revenue account. Their courts are saying that because this is a revenue account liability, this notional loss is permissible as a deduction. What is the situation if the forex liability is on capital account? I have purchased a machinery from USA. I took the foreign currency loan. As of 31st March, that loan is outstanding. As of the date I took the loan, the dollar was at say 53 rupees. On 31st March, the dollar is at 55 rupees. 10 lakhs dollar loan is outstanding. So this 2 rupees extra, whether this 20 lakhs, I can debit to my actual cost of the asset. I would like to throw this question to the audience.
Yeah, you can calculate. You can calculate. To the cost of asset.
To the cost of asset.
Yeah, I will claim.
In a similar manner, revenue loss you can claim as reduction. So the capital account liability you can capitalize.
43 capital.
Earlier this used to be a situation, but somewhere in 2005-2006 they have introduced the section 43 capital A. Now 43 capital A is very categorically talking about forex liability on capital account transaction, and it is saying that any forex fluctuation needs to be taken into account only at the time of making payment. Whenever there is an actual payment of that liability, then whatever is this forex fluctuation plus or minus, that needs to be adjusted to the actual cost of the asset. As of 31st March, forex fluctuation cannot be taken into account if the liability is on a capital account. Revenue account liability, we have this Woodward Governors India Private Limited, which is very, very clear. But capital account liability, this is absolutely not possible because of that section 43A. And this again, sometimes I feel, say contributes to that whole complexity of the tax law. Whomsoever says that tax laws are complicated, absolutely right. And we all see these kind of situations happening every time. For a poor assessee, it is very, very difficult to understand. One kind of, for him, both are say forex liability, but then our tax law wants him to say, make this fine kind of distinction. If it is a revenue account liability, you can claim it as a deduction. If it's a capital account liability, you cannot claim it as a deduction. But this is what the say, Income Tax Act is all about. So in case of this,
There also, it has to be restricted to the actual amount paid during the year. Even capitalization has to be restricted to the actual.
Yes, whatever actual payment has been made during the year, that say gain or loss you can take into consideration. Same thing I am saying, that forex fluctuation only at the time of payment. If say before 31st March I have paid some amount, that forex loss I will consider. The balance, whatever is outstanding balance, that cannot be taken into account because of 43A. So this is something about this foreign exchange loss. Then two cases I have selected. Say these earlier cases were more say based on say interpretation of the law and what law is saying and how the court is interpreting these laws. Now two cases are basically related with the practices which are followed by the say income tax officers. Some kind of practices which always create problems with say tax practitioners like all of us, and then how the courts are checking on these practices. Say a general tendency of the income tax department with which we all face problems sometime or other, that is something called ad hoc deductions. 30% disallowed, 60% disallowed. Why? Disallowed. मतलब इतना तो चलता है, we keep on saying to us in Indore, मतलब इतना तो करना पड़ेगा, you have come to the assessment and there has to be some kind of disallowance, so ad hoc disallowance. Okay. Now, mainly two reasons of this ad hoc disallowance. One is the section 48 subsection 2, related party payment. Okay, this is a payment to related party, preceding tax auditor report is mentioning this thing, I'll disallow 50% of it. One. And then another reason of disallowance, number of times they say, because say voluminous nature of transaction, that the say transactions cannot be verified, and that's why this much disallowance is being made, this much is allowance, it's something like this. Judicial authorities have came down very heavily on these practices being followed by assessing officer. A very recent, very interesting decision which has came from say Rajkot Tribunal, that is on this section 48 subsection 2, related party payment. Now section 48 subsection 2 always maintains that any payment which is excessive or unreasonable having regard to the fair market value of goods or services, or having regard to the benefits derived by the business, or having regard to the legitimate needs of the business, then only that excessive payment can be disallowed only if it has been paid to a related party. The normal tendency is this, they see, okay, this is a payment to the say director's mother, or this is a payment to the say director's wife, or something like this, this is disallowed, okay, 50% disallowed, or 60%, whatever he thinks fit, whatever he is comfortable with the figure, and he will simply disallow. Now, the Rajkot Tribunal is very categorically saying that 48-2 disallowance is possible only when the payment is in excess of fair market value. So if you want to disallow, you need to give a comparison with what you feel is the fair market value. A simple, straightforward kind of disallowance is absolutely not possible. In this particular case, assessee paid a certain amount to its sister concern. Assessing officer invoked 48-2, allowed only 1/10 of the expenditure. 10% is okay, 90% I disallow it. Tribunal said that for the purpose of determination of excessive amount, you need to give a comparison what exactly is the fair market value, what is the payment which has been made by the assessee, and based on that comparison only, the disallowance can be made by assessing officer. They observe that AO failed to bring on record what is the basis of that 90% disallowance, on what basis you are saying that 10% is allowed. If you feel it's a bogus kind of expenditure, then obviously you need to disallow the 100% of it. If you are allowing 10%, that means you are not on this point that this is a bogus expenditure. You are disallowing under section 48 subsection 2. There has to be a comparison with the fair market value. The basic condition of this comparison with fair market value has not been fulfilled, and that's why this expenditure cannot be, the assessing officer cannot disallow that 90%. Obviously, now say from this year onward, the situation has been slightly changed. Now we all know for the section 48 subsection 2, now there is this domestic transfer pricing provision, and I feel we have a session today on that particular topic also. So now 48.2 is saying you need to prove your arm's length price and everything. If you are hit by that 5 crores limit, your transactions are more than 5 crores limit, then the onus has been shifted on the assessee to prove that whatever payment he has made, that is at arm's length price. But wherever that domestic transfer pricing provisions are not applicable, less than 5 crores limit or for the earlier years, the situation is very clear. The onus is on the assessing officer to prove that what he thinks is the fair market value, and based on this only, he can disallow any payment. Rajkot Tribunal in the case of Jai Industries, 49 SOT 673. Another, say, disallowance which has been in number of cases, transactions are voluminous, and that's why it is not possible to verify all these transactions, and that's why this amount is being disallowed. Though the books of accounts are already audited, everything is there, but still they will say, well, because look into the volume of transactions, and this much percentage is being disallowed. Okay. Courts are again taking a serious view on this. In this case, assessee has paid commission to say distribution expenses to not many parties. Assessing officer allows the distribution expenses to some extent and disallows remaining expenses. He mentioned in the assessment order, looking to the rupees, same could not be verified at his end except for some small accounts. Some parties accounts 2-3 years ago. He mentioned, very honestly he mentioned that because the volume is so large and because the time available at my disposal is so short, I have a number of other things to do. So that's why I will not be verified and that's why I am simply disallowed. Circular simply held that it is the duty of the assessing officer to verify the books of accounts. Assessee has produced all the material, all the evidences, whatever is the quantum of transaction. Assessing, it's the bounded duty of assessing officer to verify whatever condition has been made by assessee. If you fail to discharge this duty, you cannot penalize the poor assessee for this purpose. This is what tribunal has said, and then High Court ultimately concurred with ICAT. Without verification, how you can say part of it is genuine and part of it is non-genuine? Either you verify 100% and then come to a conclusion. Simply for not verifying the book, not able to verify the books of accounts, you cannot disallow anything. Punjab and Haryana High Court, Shri Krishna Enterprises decision. We always need some proof. Number of times this happens. Say assessing officer by saying, blatantly saying that okay, I will disallow this much amount. Then they always have audacity to say, okay, sir, आप appeal में छुड़ा देना. You go into an appeal and appeal will come to rescue. And so we always need some kind of counter attack, some kind of say check against these kind of practices. And these are the decisions which always help us in those say practices which are followed by assessing officers. They will keep on disallowing, but at the appellate level you need some kind of say weapon against that. So that is always the situation. That the accountability is always an issue at the level of assessing officer. They will do whatever they want. Case at appellate level, and then these kind of decisions will come into picture. Now, again, coming to another decision that is related with again the interpretation of law, how say interestingly court interprets the various provisions. This is a typical kind of situation. Section 43B, disallowance of certain payments unless and until disallowance of certain expenditure unless and until actual payment has been made. Then section 43B, we all know, has say 6 expenditures covered there. Last one being section 43B clause F, the latest kind of entry, the leave encashment payment. Okay. LIC has come out with a scheme where they say first your leave encashment liability. Because of say this accounting standard 15, now I need to provide for all these retirement expenditure and everything. So LIC has come out with a scheme like gratuity. Now they are funding this leave encashment payments. Also, you take this policy, pay a regular kind of premium, and then whatever leave encashment liability is there, that will be then ultimately paid by LIC. They make this whole actuarial valuation and everything, and then give you this kind of policy. The issue which came that whatever premium has been paid to Life Insurance Corporation towards this 43B leave encashment policy, whether that is allowed as deduction. Group leave encashment scheme, assessee took a policy, paid the premium, claimed the deduction. Assessing officer allowed it, but then CIT got angry and he invoked section 263 and said that this is a clear-cut violation of section 43B clause F. 43B clause F says that leave encashment actually needs to be paid, then only deduction will be available. Here you have not actually paid that leave encashment amount, you have simply paid that insurance premium, so deduction will not be available in this particular case. CIT revised that assessment order. The contention of assessment, it was a very interesting kind of contention. Assessee said that now since I have taken this insurance policy, I will never be required to make that payment of leave encashment amount. That payment is now absolutely liability of the insurance company. So you say that you will allow me this deduction only when I will be actually paying that leave encashment amount. So this will never happen. Since now I am insured against that particular liability, so I will never make that particular payment. That liability shall never arise in my case. And that's why this insurance premium should be allowed. Interesting kind of say argument given by the SEC. Tribunal accepted that particular contention. Department went into appeal. Kerala High Court rejected the department's contention on two observations, and these two are very, very important for that section 43B clause Act. One observation of Kerala High Court is this, that Calcutta High Court, in case of excise industry, has already declared 43B clause Act as unconstitutional. In fact, how this 43B Act has come into tax law? There was this decision of Supreme Court in the case of Bharat Earth Movers Limited. To override that particular decision, they have introduced this say clause F in section 43B. Calcutta High Court examined this whole situation, and then they have said that despite of that amendment, despite of that introduction of clause F, the Supreme Court decision still stands. This amendment doesn't take care of whatever was objection at the Supreme Court level, and that's why this 43BF is unconstitutional. This is what Calcutta High Court has said. Kerala High Court in the present case asked the department whether you have challenged this particular decision of Calcutta High Court. There was nothing in the appeals filed before Kerala High Court that Calcutta High Court has been challenged, and that's why Kerala High Court came to the conclusion that department has already accepted whatever has been decided by the Calcutta High Court. Now you cannot place into say assessment this section 43B clause. This is one of the situations related to this 43B clause F, that leave encashment payment. In the present case, then High Court further analyzed that insurance premium per se, agreed with the SAC's contention that since SAC is now insured against that particular payment, the liability of that payment shall never arise on the SAC. So now what SAC is claiming a deduction is not of that leave encashment payment, but an insurance policy which SAC has taken to cover itself against the future liability, and that insurance policy is now a business expenditure clearly allowed under section 43 subsection, under section 37 subsection 1. So 43B is no more applicable in this particular case. That was another observation made by Kerala High Court. And sometimes I really feel that the High Court number of times, or Supreme Court or High Court number of times, they analyze the law in such a clear-cut kind of manner. If it's a slight amount of that activity comes to say at the level of our departmental officers, probably this whole issue may not arise. But for every small issue, you need to go again and again to the High Court, Supreme Court, and the High Court was very clear in this case that since now no liability under section for leave encashment shall be arising on the SAC, this is a 37(1) deduction which he is claiming that should be allowed to the SAC. There is a decision of Kerala High Court, Hindustan Latex Limited, 209 Taxman 142. Sir.
And in the case of excise duty, they said it is not, I mean, they have to pay the tax. They have paid the tax.
Okay, but Kerala High Court has said that this fact is not finding a mention in the appeal which has been filed before the Kerala High Court.
The Kerala High Court judgment is not final as a day.
Yeah.
In other states, there has been teaching some cases, particularly in other states. Liberal and where they carry out the restrictions of the right.
Okay.
But here also, they are going to go on the report. It is pending agreement. They will order on the
Okay, so department is an appeal.
Yes.
Okay.
Another High Court. These are the High Court.
In Andhra Pradesh High Court, the department is an appeal.
Yes.
But okay, but then yeah, the revision petition has been accepted, but then Kerala High Court has said that department has not made any mention in the appeal which is before Kerala High Court. Okay. Whatever has been said by the Calcutta High Court. Yes, yes. another logic. Say if the section itself is unconstitutional, then there is no need of going further. But then they analyze the transaction itself also. That in this case, that the amount is not covered in 43B at all. This is the 32nd one deduction which I am placing. Okay. Bharat Approvals, it was the origin of this whole section.
Because you made an amendment, this is not affecting the unconstitutional. They are holding that unconstitutional of the amendment brought in Section B.
Yeah, because the whole idea of 43B was protecting the statutory payments which SSC is making. The Bharat Approvals were already on this point only. That whatever is covered in 43B is normally the statutory liabilities, which SSC is claiming as a deduction but not paying. So double loss to the government. This re-engagement has nothing to do with the statutory liabilities of the SSC as such. And that's why that issue was there in case of Bharat Approvals. This re-engagement is not held by the 43B. Now Circuit High Court is saying that it is still applicable. Now the department is filed a review petition, but still the Calcutta High Court is still alive. That the decision still holds good.
The whole question of the Bharat Approvals was there. Before coming involved, the liability you can be determined.
Yeah. Yeah, it will determine liability. Very good.
That was the basis for this covenant and for the result that we used.
Okay, another issue still related with this employee's payment, and this is a very ticklish kind of situation. Deduction of employee's contribution to say this provident fund and ESI. Okay, somehow there is a problem in the way the law has been written, but the court, whatever decision they are now giving, we need to go by. The whole issue is this, that this contribution to the provident fund, employee's contribution as well as employer's contribution. Now, so far as employee's contribution is concerned, the matter is very clear. Again, 43B comes into picture that this employer's contribution needs to be paid on or before the due date of filing of return. Then only deduction will be available. 43B. There is an interesting problem related with the employee's contribution and how this problem comes into picture. That is again an interesting part how the Income Tax Act is drafted. Section 2, subsection 24, which defines the income. This section says that whenever you deduct something from the employee's salary in the name of this provident fund or whatever contribution, it becomes your income. The moment you have deducted, this will be treated as your income. Then, when you will deposit it to the same provident fund account, then you will get a deduction under section 36(1) and net position will become zero. First, it has been treated as an income and then it will be allowed as a deduction. An issue has already been raised. Why these kind of provisions which unnecessarily creates complication? This is a clear-cut deduction from employee salary and you are treating it as an income. And the idea was this, that in order to encourage the companies to make that provident fund deposit on a regular basis, timely basis, this provision has been introduced. Somebody always raise a question that what exactly is the purpose of Income Tax Act? Whether we try to make income tax as a solution for all kind of problems in the world, whatever is the law, you need to ensure compliance only through the Income Tax Act. It would have been better if you left the poor Income Tax Act only for say collecting the revenues for the government. Don't try to make it a solution for all kind of problems. The PF Act violation and we will tackle through Income Tax Act and any other kind of problem we will again tackle through the Income Tax Act. What kind of complications you will create? You keep on introducing complications, but this is what is the law of land. Once you have deducted from the employee's salary, this is your income under section 224. Then you deposit, you get a deduction under section 36. The point is, whether in respect of employee's contribution, do I have an extended period of deposit till the due date of filing of return, or that I need to deposit as per the due date given in the Provident Fund Act itself? The conclusion is because of the use of term due date. 43B also talks about due date, and there they are referring to the due date as per filing of return. 36 one also talks about due date, but probably they are referring there to the due date as per Provident Fund Act. So employer's contribution 43B, employee's contribution section 36. Now what has happened in this particular case? Assessee paid to make this deposit, this contribution, and practically this happened. That whenever there is a delay in deposition, then the delay will be with respect to both the parts of contribution. Employer contribution will also get delayed. Employee contribution will also get delayed. Assessee delayed that deposition but deposited before the due date of filing of return. Claim the deduction. Assessing officer says that so far as the employer contribution is concerned, I am okay, you have deposited it before the due date of filing of return. So far as the employee's contribution is concerned, I will disallow it. He raised section 36(1) as saying that employee's contribution needs to be deposited on or before the due date as per the Provident Fund Act itself. Now, this is the kind of problem which the Income Tax Act is always having. Disregarding the practical situation, how this is possible that assessee can deposit one part of contribution before the Provident Fund due date and then he will be depositing his own contribution up to the return filing due date. But this is how something law is there. But then again, the courts have came to the rescue of assessee. They have somehow extended the provision of section 36(1) and then they are saying that even in respect of employee's contribution, if there is a delay in deposition beyond the due date specified by the Provident Fund Act, there will be consequences in the Provident Fund Act itself. You will be liable to pay interest and penalty and everything. But so far as Income Tax Act is concerned, if you deposit both the contributions before the due date of filing of return, you will be getting a deduction. Somehow the court read that section 36(1)(5)(a) in this particular manner. Delhi Tribunal is now saying that even in case of employee's contribution, if it has been deposited up to that return filing due date, 43B, employer's contribution, already that relaxation is there. Even in respect of employee's contribution, Tribunal is now saying that this can also be deposited up to the due date of filing of return and the assessee will be getting deduction in the original year itself. Somehow the law has got its own set of complications, but now Tribunal is providing some kind of relief because again the ground reality is this: if there is a delay in deposition, it is with respect to both parts of contribution, employee as well as employer. For employer contribution, if Income Tax Act has given that extended time period, Tribunal is saying the same extended time period should be applicable in respect of employee's contribution also. 188 Taxman 265 Delhi, and then again we have say Delhi Tribunal decision also, again another say 2011 decision, Sudhir Jaisak Limited. Sorry? On the employee's contribution part. Another issue, and now this time coming from Supreme Court. Expenditure in respect of, say, provision for deduction in respect of provision for warranty expenses. Normally again, provisions are something which is say not digestible by Income Tax Department. The moment you claim any deduction on account of provision, and they will have their own say way of looking at things. You need to have an actual liability and then only deduction will be available. A provision we will never allow the deduction. But a Supreme Court decision in the case of say Roto Control Private Limited has started the trend in the say business deduction, and now Supreme Court is saying that a provision for expenditure can also be claimed as deduction provided it fulfills certain conditions. Okay. Normally we say that accounting and taxation are not good friends. Tax authority normally maintains that whatever you want to do, you do in accounts. Income tax is our kingdom, we will do as per the Income Tax Act. So any provision, normally they do not, they are not inclined to grant a deduction in respect of provision. Now what has happened in this particular case? Assessee was engaged in manufacturing of some technical, mechanical kind of items. They, with every item, they provide some kind of say 6 months repairing warranty or something. Whatever was the sale which has been made during the year, based on past data, they did a statistical analysis and they find out that if my sale is of this much units, this much is the say warranty expenditure I need to incur in that 6 months. Based on that calculation, they made a provision as on 31st March. Assessing officer said that there is no actual liability. You have not actually incurred that particular voluntary expenses. Your client has not actually claimed for that particular voluntary expenditure, and that's why this will not be allowed. This is only a contingent liability. Tribunal supported the assessee. Madras High Court rejected. Ultimately, Supreme Court analyzed that whole matter from a very interesting accounting perspective. The whole analysis has been made. This case I have selected mainly because the kind of accounting analysis which the Supreme Court has done, and as a member of the accounting profession, we all should feel proud about this particular thing. That ultimately the apex court of the land is giving due recognition to the accounting principles, and based on accounting principles, then they are deciding whether the deduction should be allowed or not. Supreme Court has said that in respect of this voluntary expenses, there are three options which are available. Either you account for in the year in which it is incurred, or you make a provision only in the year when customer makes a claim, or you provide for warranty based on some percentage of your turnover, based on your past experience. If I have sold 1 lakh pieces, so probably in 10,000 pieces there will maybe some kind of problem, and I need to provide for this particular thing. Three accounting options the Supreme Court has created. Then they analyzed it further. They say that first option is not possible because this will amount accounting on cash basis. You are accounting for warranty expenses only when actual expenditure has been done. So this is the cash system of accounting, which is obviously not acceptable. Second option, when customer makes a claim and then you recognize that particular liability, that is again going against the matching concept. You need to follow the matching concept. In the year in which you have booked the revenue, in the very same year you need to provide for that particular liability. So neither you need to account for based on say actual expenditure, nor it is permissible to account for whenever the claim has been made by the assessee. The only option which is possible, that is make a say past analysis. What is the say reasonable amount of expenditure you are incurring every year based on your turnover on a yearly basis, and calculate that particular amount. The Supreme Court has actually analyzed what exactly is a liability, and they say that for getting any deduction, there must be a present obligation arising from a past event. Court has said that in this particular case, the moment you have sold your item, you have incurred a liability. The generation of liability is there. Quantification may be an issue, what may be the amount of that liability, but the liability is already there. The moment you have sold 1 lakh pieces, it was confirmed that on and about 10,000 pieces you need to take for repairing. So liability has already been generated. Quantification may be an issue, but since the liability is there, the deduction is available to the assessee in the very same year. So that is particularly a ground which is now being taken by a number of other courts, claiming deduction on account of provision. If liability is already there, may or may not be quantified appropriately, but if some kind of statistical data is available for the quantification of that liability, now courts are allowing that provision also as a deduction. This is a decision by Supreme Court in the case of Judicial Control India Private Limited. On the similar line, earlier we had a decision from Delhi High Court in the case of Sony India Private Limited, where they claimed this warranty expenditure in respect of television which they were sold. And now Supreme Court is giving a finality to this whole situation, Judicial Control India Private Limited. Okay, I think I have already on the boundary line, so one or two more issues are there. Firstly, I think I can wind up with this. This additional depreciation. Okay, this is the last issue which I would like to discuss. Additional depreciation, and the point which I will be making here is how something which is allowed by law is taken away by the procedural complexities which are there. Additional depreciation. Section 32, we know assessee is a manufacturing entity. New plant and machinery, 20% additional depreciation is available. This 20% additional depreciation is a subject to that 180 days rule, 180 days concept. If the asset has been put to use for less than 180 days, then obviously the 50% depreciation is allowed. So what happens that 20% additional depreciation gets cut short to 10% if asset has been put to use for less than 180 days. Asset said that law is giving me say allowance of 20%. 20% I need to be allowed. If you are allowing only 10% in the first year, balance 10% I need to be allowed in the next year. 20% is my allowance. I will comply with all your requirements, all your conditions. 20% all in all depreciation I need to be given. Because of this provision, you have restricted it up to 10%. I need to be allowed the remaining 10% in the next year. Tribunal accepted. Tribunal consented with the assessor's argument that yes, 20% is your eligibility on account of additional depreciation. Since you have been given only 50%, only 10% in the earlier year, balance 10% you are eligible to claim in the next year. This is what is this Delhi Tribunal decision in the case of SIL Investment Limited. Okay. Now the point is, tribunal is already there, and in as per tribunal, you can always claim it as a deduction. But nowadays what is happening, number of cases we are observing where the law permits something, courts permit something, but procedure creates a problem. I needed to file my e-return. E-return works on a predefined kind of schema, whatever XML format they have decided, they have got their particular software. The problem is this, in that particular schema, there is no option available to implement this particular kind of situation. They do not allow you any additional 10% depreciation, and there is no format available where you can claim this kind of thing. But legally speaking, this is permissible. Delhi High Court is already there. This additional depreciation can be claimed as deduction, balance in the subsequent year. How this will be done practically? Obviously, the court is not going to give us any kind of help on this part. Legally, this is not permissible. Additional depreciation. Okay, I think I need to wind up at this particular point of time. Some say final words based on this. So we always say Income Tax Act is the most complicated kind of act. I always feel that controversies are built into the very nature of Income Tax Act. Till the Income Tax Act will be there, controversies will always be there. We all need to be prepared about all these things, be it business deductions, be it PDAs, be it MAT, or be it any part of income tax. Controversies are built into the very fabric of Income Tax Act itself. The only thing which complicates this whole situation, that is, say, the over-zealous attitude of our assessing officers, always trying to say, stretch their hands as much as possible, always trying to say, collect as much tax as possible. This basically creates a problem. Frankly speaking, no solution is available to this particular situation. The only possibility is keep ourselves updated as possible, as usual as possible. The only solution, courts and tribunals, and they all are there to help us. To the extent we are updated, we will be able to save our clients from all these problems. Okay. Thanks a lot to all of you for giving me this opportunity.
Remember, the speaker is available for next couple of hours. If anything is still in the pending, then we can take the clarification on the business directions issues. So thank you, sir, for sharing the knowledge and the updated issues on business directions. On behalf of the members, my request C.S. Reddy to present. Thank you, sir. Dear members, we want to share the two small information and request to all the members. We have two counters and three counters backside of this venue, and also I request to all the members and information also. Up to yesterday we got the only less than 300 registrations only. Now to become more than 350. So we request all the members, we provide on the website to post the registration without paying information to the branch, because we will get attendance on the seminar. Please provide the